Welcome to the 3-Edge Week in Review for the week of June 12th. I'm Fritz, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3-Edge Asset Management. And now this week, Steve and I will discuss the Fed's decision not to increase short-term interest rates during Wednesday's FOMC meeting, thereby marking the end of a streak of 10 consecutive interest rate increases, which began back in March of 2022. Steve and I will examine this non-move by the Fed and what it could signal for the economy and the market in the months ahead. Before we get into that, let's take a brief look at recent activity in the markets, where, again, the biggest news this week came from the Federal Reserve when on Wednesday, the Fed's Policy Setting Committee, the FOMC, announced that it would not raise short-term interest rates. However, the Fed also indicated that it was likely that it would need to raise interest rates again before this year is out in order to combat inflation that is coming down, yet not quite approaching the Fed's 2% target yet. Then on the following day, on Thursday, the European Central Bank, the ECB, they actually raised interest rates in the Eurozone by 25 basis points to the highest level in 22 years. In her comments after the announcement, the president of the ECB, Christine Lagarde, indicated that it was likely that the ECB would need to increase rates again, even as soon as their next meeting, which is in July. And thus far, this month of June has been a strong month for global equities. With a little over a week ago, the S&P entered bull market territory, and the S&P has now risen by over 20% from its lows in October 2022. Global equities also received a boost from China's announcement of a stimulus package to stir economic growth, and we are continuing to see the optimism over the potential for artificial intelligence to supercharge the global economy. Lastly, this past week, we also received the latest update on inflation. Consumer prices climbed at an annual pace of 4%, which is actually the slowest pace of growth since March of 2021. So that's a significant slowdown from the prior month as well. And then growth in the core CPI, which, as we know, takes out food and energy, that slowed to an annual pace of 5.3%, down from 5.5%. So in general, the inflation report was positive. But as I said earlier, the Fed's quest to rein in inflation is far from over. And it appears like they still have some work to do to get to the 2% target. So let's get started. Let me bring Steve in here. So Steve, as I mentioned, after aggressively raising interest rates over the past year plus, the Fed is taking a breather or a pause or a skip, whatever I guess people choose to call it. But why do you think they've chosen to pause here? And what does it mean for the economy and the markets?
Well, as we've discussed in the past, the Fed has a dual mandate. One is to promote low unemployment, and the other is to maintain inflation at or roughly their 2% target. And unemployment has pretty much been at the lowest it's ever been in the last 6 decades. And inflation is still, even though it's coming down, still well above target. So several members of the Fed have been advocating to keep raising rates. However, the chair of the Fed, Powell, elected no. He wanted to pause, perhaps a fear of tipping the economy into recession and not wanting to do that. And so for him to gain consensus, I believe he had to agree that he would telegraph, don't worry, this is just a temporary pause. He'll continue to raise rates later just to get everyone on board and have a consensus. However, I think the Fed is seeing through the bluff, and the Fed is, the markets, are seeing through the bluff. And I believe that the markets are acting as though they're done hiking rates.
Right. Yeah, absolutely. It strikes me that it's actually perfectly rational to stop and pause because we know there's a lag, but people just get, they create such a frenzy regardless of what they do. It's really incredible. Anyway, as I mentioned over, what we've seen with the S&P, though, is the standard definition of a bull market here, advancing 20% from its October lows. And so I guess the question is, well, okay, so is this pause or skip by the Fed, is that going to keep the equity markets moving higher from here? and or not, I guess, and what are the potential risks to the equity markets even after the Fed announcing their pause this week?
Well, leading up to the current situation, we've had numerous leading indicators that are often very reliable over history, pointing to a high probability of a recession and a market downturn down the road. The lag is always tricky to know how long that might take. But we've had an inverted yield curve, meaning that short-term interest rates are higher than long-term interest rates, an unnatural situation. Any time in history that the U.S. has had this inverted yield curve for this long, in 100% of the cases, we've had a bear market and a recession following. So this would be certainly an exception if we don't. We've had quantitative tightening, which is a complete reversal of what the Fed's been doing over the last several years, which is printing money and expanding the balance sheet. Now they're going in reverse, and one would think that instead of creating asset inflation, it would start to squeeze the markets down. We've had the Treasury cash balance wither away during the debt ceiling. And when they extended the debt ceiling, now the Treasury has to go into the market and pull somewhere between $500 billion and $700 billion out of the market to replenish its cash reserves. That could certainly hurt the market. We've had the stimulus funds that have propelled consumer spending longer than most people thought, finally looking like they're drying up. Money supply, which is an effective leading indicator, has been declining rapidly. U.S. stock market valuations were already historically high even before the run-up this last week. So a lot of things have been pointing to the downside. However, in my opinion, a bluebird has recently arrived. So what's a bluebird? So I think of the bluebird as an opposite of a black swan. We've talked about black swans in the past, where it's an unexpected, unpredictable event that comes out of nowhere or seemingly out of nowhere and hits the market, hits the economy, and causes a downturn that no one might have expected. We've had the opposite of that happen recently, and I would call it a bluebird. And you alluded to it earlier in your comments, and it has to do with some incredibly breakthrough achievements with artificial intelligence and this program called GPT. You know, I'm here in Seattle right now at a board meeting, but I've been able to talk to people who are very close to the situation. And even beyond what's been reported in the press, it's really quite remarkable what some of the breakthroughs have been. The latest, a lot of people are talking about Chat GPT, but they've gone well beyond that. And the latest findings are when they increased the number of parameters that simulate neurons in the programs from billions to trillions, the breakthrough was much more significant than anyone might have predicted. And so this is causing tremendous excitement in just a handful of stocks, but that handful of stocks has such high market value that it's dragging all the indices higher. It's causing market psychology to really improve tremendously with a lot of excitement about the revolutionary changes. And then as the whole index goes up, you've got a lot of machine trading algorithms trading in the market that are seeing the momentum, and they're trained to follow the momentum and follow the trends. Then that causes what we know as FOMO, F-O-M-O, fear of missing out. And not only retail investors, but institutional investors feel underinvested. So this tremendous bubble is being recreated. And my guess is that with the rapid change in psychology and the rapid gain in the market, the Fed might look back and regret that they skipped this rate hike.
Yeah, very interesting. So, as always, my final question is based on what we've talked about here today and the fact that the Fed has chosen to pause, not raise short-term interest rates at their meeting this past week. And maybe also, though, based on what you mentioned in terms of this idea of the bluebird, how should investors think about positioning their portfolios based on what we've seen transpire over the past week plus?
So there's a balance. I think this Fed skip, the fact that they didn't raise rates, could possibly delay further the chance of an oncoming recession. But if market psychology continues this exuberance, we could have another extended period of market gains. Market history shows that market bubbles and big rallies can extend far longer than logic would suggest, and the momentum and the psychology feed on one another. But then when it's over, look out, the following downturn can be equally steep. So our thought is that this is not the time to be fully invested in U.S. stocks, although it's so tempting because the U.S. stock market is outperformed and done so well. But also, we think it's perfectly reasonable to be well above a normal minimum equity allocation. So, this could continue quite some time. And there is real substance to the potential productivity gains that come out of these AI breakthroughs. And that could extend the record level of profit margins a bit further than most people were suggesting. Now, we do own, for our clients, allocation to the S&P 500 index, which includes lots of these stocks, and that's part of our minimum equity allocation. Beyond that, we have added allocation to another market that is also doing very well this year. In fact, it's still exceeding year to date the performance of the S&P 500, and those stocks are much more fairly valued than the U.S., and that's in Japan, and that's been working very well. In addition to that, we do have a well-diversified portfolio outside the stocks to account for different scenarios. We own TIPS, Treasury Inflation-Protected Securities, and gold in case this bubble bursts because of stagflation. If inflation now continues to or reverses and rebounds with the Fed stopping raising rates. We also own treasuries, which would be a good hedge against a recession if it does come, like so many indicators are predicting. So stay well diversified, invest in equities, but not at full tilt, and be worried that this might not last forever.
Excellent. Great. Thank you very much. Terrific insight, and which is important because it's been so long that the Fed has just raised rates one meeting after another that, this is different. So, and, my takeaway is sometimes I think like, well, even if they pause and don't raise rates for the rest of this year, I mean, we still haven't felt the full effects, of the tightening. It's been so aggressive and so fast. So I think that is still to come. So keep it tuned to our weekly videos, and we will report out what we see in the economy, in the market. So thank you very much, Steve. That will do it for us, but we'll be back next week, another edition of the 3 Edge Week in Review. As a reminder, all our videos are always available on our 3 Edge YouTube channel. You can go to YouTube and just type in 3 Edge, and you will see our library of videos there. And all our written commentaries and our videos are always on our website, and that's 3edgeam.com. So until next week, on behalf of Steve and everyone here at 3 Edge, thanks for listening.